This is the financial profile of an AI boom. In just 12 months, Micron's quarterly revenue surged from $9.3 billion to over $41 billion, while net income spiked to $28 billion in a single quarter. Analysts responded to this growth by issuing aggressive future price targets, with several major firms projecting the stock will reach $1,300 or even $1,600 per share. Yet, while reporting the most profitable quarters in its history, Micron Stock did something unexpected. It crashed nearly 40%. At current growth rates, a $1,300 target is mathematically grounded, but the market's refusal to buy suggests investors expect these earnings to collapse as quickly as they arrived. The reason for that skepticism is a specific figure buried in the earnings report. Micron's non-GAAP gross margin reached 84.9%. For a software giant, a margin this high is a victory, but for a hardware manufacturer, it is a danger signal. Historically, memory chips have never sustained these levels of profitability. Optimistic analysts argue that specialized AI hardware has decoupled profit margins from the traditional supply cycle. Veteran semiconductor investors see the exact same 85% figure and prepare for a supply-side crash. Memory manufacturing is governed by a rigid economic reality. Extreme scarcity allows for massive markups. When the world runs out of chips, Micron's profits soar. But high margins trigger the same response. Manufacturers use hash piles to build new capacity, deploying a $25 billion budget. Eventually, new factories finish construction. The market is flooded with chips, and supply catches demand. When that happens, prices drop rapidly, margins vanish, and the stock price is cut in half. This historical loop is why the market sells at 85% margins. Investors are trying to exit before the next round of new factories turns on and destroys the current pricing power. Micron is attempting to defend itself against this cycle by leveraging the unique nature of AI hardware. Because AI requires high bandwidth memory, which is difficult and slow to produce, customers are securing their supply through 16 multi-year agreements worth $100 billion. These take-or-pay contracts require customers to honor specific volume commitments and rigid pricing floors, effectively shielding Micron from the price drops that usually end a memory boom. If these contracts hold during a downturn, Micron will have overridden the boom and bust cycle that has dictated the industry's profits for decades. To see if $1,300 is a realistic price, we have to look at the math behind the earnings shield. Based on current quarterly profits, Micron is on a run rate to generate roughly $72 in earnings per share this year. At a $1,300 stock price, the company would trade at 18 times those earnings. Compared to most high-growth technology companies, an 18 times multiple is actually quite low. It suggests the stock is inexpensive relative to the cash it is generating. However, that 18 times multiple only looks cheap if that $72 in profit doesn't collapse when the next wave of chip supply hits the market. The $1,300 target is mathematically sound, but it depends entirely on the belief that these new AI contracts can withstand a market shift. Buying Micron at these levels is a bet that today's record-breaking profits have become the new baseline for the company. The weakness in this argument is that these $100 billion contracts have never been tested during a real-world supply glut or a major economic downturn. Analysts are pricing in a future where these agreements are ironclad, but until we see a customer honor a pricing floor while cheaper chips are available elsewhere, that durability remains unproven. To gauge the risk, you can ignore the daily stock price and focus on a single piece of evidence. The defining metric for Micron's future is gross margin. If margins stay above 80% as new supply comes online, the contracts are working and $1,300 is a floor. If margins slip towards 70%,